Jamie Dimon stood up, I think it was in April this year, at a banking conference in New York and said 2 weeks ago, I said that the US economy was facing a storm. I've upgraded that to a hurricane. And we at JPM will take action to protect our shareholders from this hurricane. But you could see even then which way this was going. It was the end of the expansionary cycle. Bankers were getting really worried. And if Jamie Dimon says something, he is the most powerful banker, commercial banker in the world. Everybody listens to him in the banking community. That, I think, really did mark the top, if you like, of bank credit expansion. And any banker who's ignored that warning from Jamie Dimon really should be sacked. And that's where we are now.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for November 1st through November 8th, 2022, while supplies last. This week we feature two silver specials. First, we have 2023 Silver Britannia at only $7.89 over spot. Now, while the Royal Mint has already started minting King Charles commemorative coins, this first run of 2023 Britannia still features the portrait of Queen Elizabeth II. Next, we have 90% silver at $11.49 over spot. Prized for its recognizability, easy divisibility, and liquidity, constitutional or junk silver is also in short supply. As Andy Schechtman says, they're not making any more of it. Our constitutional silver is mixed, meaning it may come as dimes, quarters, or both. But either way, it has the same silver content and is only $11.49 over spot per ounce while this batch lasts. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest. Alasdair Macleod is a former bank director, now an analyst of many types of financial markets. He joins us this Wednesday, November 2nd, 2022. Alasdair, thanks for coming back on Liberty and Finance.
That's my pleasure, DK.
Our audience always anticipates your arrival here with high outlook, and they've submitted more questions than we could possibly answer during this short visit we have together. But I wanted, if we could, before we turn to viewers' questions, to get you to tell us a little bit about your current research, which I understand is about the size of the derivatives market and this idea about an unwinding of the derivatives and how it's both necessary and going to be very impactful to our financial lives. And most people have no clue about the scale and scope and magnitude of this, nor the immediacy that things are going to start happening. Can you talk to us about this derivative unwind 2.0 that you've been researching?
Yes, certainly. It's a very interesting. I find it a very interesting topic, and it is going to have, I think, a major impact on the whole of the banking community. We are transitioning from an environment where interest rates over the longer term have just declined, and they got down to zero in the US and slightly negative in Europe and also in Japan. That is now reversing, and it's actually reversing very, very rapidly, as we're all aware. And actually today, we do expect later on the Fed to come up with a new rise in interest rates. So given that we've got now a new trend in interest rates, which is rising and likely to be for some considerable time, I'm not going to say how much it's going to rise, but it is going to rise over some considerable time. I mean, not just a year or two, but I think the outlook is for decades. The whole of the over-the-counter derivative markets, which on the last count from the Bank of International Settlements totaled $600 trillion in notional value. All that basically built up on the back of declining interest rates. Now that we have got rising interest rates, then the question is, what will happen to those derivatives? And the answer, when you look at it quite clearly, is that with increased counterparty risk, what you're going to find is that, for example, foreign exchange derivatives, which are basically delayed settlements or swaps from one currency into another, the increased systemic risk from contracting bank credit, which is now what we're beginning to see, is likely to hamper that market quite significantly. So I would expect that roughly 100 trillion market to begin contracting. Now, the biggest market by far is the interest rate swaps market. That's interesting. It's very different from a lot of the other OTC markets in that the gross market value is what you need to look at, and that is what appears in the bank balance sheets. The notional value really doesn't matter in credit terms in this case, because what an interest rate swap is it is agreement between two parties to exchange, on the one hand, a fixed income stream, and going the other way, if you like, floating interest payment. So, that is, if you like, how a mortgage company will finance a fixed rate mortgage, say for a period of up to 5 years. It will do it through an interest rate swap. That market has grown to approximately $400 trillion equivalent. So in other words, it is roughly 2/3 of the total. Now, obviously, where you have had a long-term decline in interest rates, what has happened is that this market has grown and grown and grown. Why? Because people from pension funds to homeowners financing their mortgages have preferred to try and lock in a fixed rate of interest rather than expose themselves to the vagaries of a floating rate. That is why this market has grown so substantially. Now that you've got rising interest rates, that no longer works because the providers can't do that long term. They can't say we can guarantee the rate at 2 years or 3 years. I mean, if they were to do that, they would have to raise the rates quite significantly, which would make it extremely unattractive to anyone taking up the offer. So in effect, it looks to me as if the whole of that market is threatened with disappearing. So, I mean, that becomes 2/3 of the total OTC markets. There are other pockets in there. For example, you've got commodity deals, which is a subject which is close to our heart, insofar as it affects precious metals in particular. And they have been used for a different purpose, and that is to back unallocated accounts, because the bulk of the forwards and swaps that are recorded as OTC derivatives are LBMA contracts. They are contracts basically to deliver gold at a future date. So, it is a credit. It is a credit contract. And at the moment, or rather on the last figures we have, which were the end of last year, we're looking, I think, at a figure around about 8,000 or 9,000 tons equivalent in those forward contracts and swaps. The point about those is that they back unallocated gold accounts at the bullion banks, so that if you or I were to open a bullion account at a bullion bank, it would probably be an unallocated account. That's what we would be encouraged to do. And originally, this was done so that demand for physical gold could be sidetracked into paper. And that's what's happened. And we're aware of this, and we see paper really dominating the pricing of gold, both in COMEX and also in London with the fixes and so on. So the point about this is that this change in interest rate environment and the tendency for banks to now begin to contract their outstanding bank credit is going to have a major impact on all areas of OTC derivatives. And it is going to be a major effect. We saw, for example, the recent problems that Credit Suisse has become very, very public. one of the things they're trying to do is they're trying to sell off their derivative origination departments. And you can see that they're having to contract their balance sheets in order to stay solvent. And this is going to be a problem which bankers in general are going to face, and particularly in the global systemically important banks. That's going to be very, very visible to us. And as that happens, systemic risk is going to escalate. So it's going to be interesting times, as it were. And I think that the likelihood of a bank failing in all these cross currents, I think, is actually quite substantial.
It was interesting because just a few weeks ago, there was a story that came out that the Royal Bank of Australia, the RBA, was on paper insolvent. And they said, well, technically it's not insolvent because they can always bail themselves out. And then there was also the Bank of England that got under a lot of pressure, when the government had to pivot recently on quantitative easing, that sort of thing. So there's a question from a viewer that ties right into these points that you've been asking. That is, Michael Haller says, which major currency do you think is at risk of collapsing first?
It's a very good question. I honestly don't know. The one which I see most dangers in is the euro. I think that's a pretty good candidate for the first one to collapse, partly because it's an invented currency. I mean, at least the dollar has a history of being, exchangeable for gold. Same with sterling. And really what that means is that over time, we've accepted dollars and we've accepted sterling as a currency, which, because it was originally backed by gold, has some sort of legitimacy. But you can't really say that about the euro. I mean, just imagine, if you were living in Germany and the mark had been sort of folded into the euro. Now, you will have memories of the mark. But when it comes to the euro, you don't have the same sort of attachment. There is, therefore, I think, a far greater risk that residents in the eurozone will discard their currency a lot sooner than, say, is the question in Japan, where they've still got a savings culture intact, which Germany had, by the way, and also in sterling and also in dollars. So I think I would say that the euro is the initial candidate. And the other problem that the euro has is that all the central banks in the euro system, including the ECB itself, because they have taken on substantial quantities of government bonds, which with rising yields have fallen in price, they have all become technically insolvent. Now, I'm not saying that this is impossible to deal with. It's very possible to deal with, but the system makes it difficult in the sense that for the ECB to recapitalize itself, it needs to do it with the assistance of the national central banks, because the national central banks are the shareholders. It doesn't have a government to turn to. And it's the national central banks that then have a government to turn to. So if you think about the Bundesbank effectively would go to the Bundestag, the parliament, and say, we need enabling legislation to recapitalize ourselves and to recapitalize the ECB. Now, you and I can see quite quickly that, some politician's going to jump up and say, hold on a minute, the Target 2 system, you're owed 1.2 trillion euros. What's the position there? You can see that the whole can of worms begins to open on this. I'm not saying that it's impossible for this to be resolved, but what I'm saying is that it's extremely difficult. And this difficulty comes at a time when major GSIBs in the Eurozone, their share prices are reflecting very, very substantial discounts to book value. I mean, you've got Credit Suisse are at Switzerland next door, as it were. I mean, that's about 25% of book value. Deutsche Bank is about 26% of book value. I mean, there's several others in that sort of range. I mean, this is option money, which basically tells you that the markets think that these banks are insolvent or will need rescuing or something. But anyway, I mean, the last thing you want to do is to own shares in it. I mean, except at a very substantial discount to book value. So I think that, to answer your viewer's question, I think probably I would say the euro is my candidate for the first one to fail.
The other point about the euro that you have brought up in the past, but I didn't hear it just now, was about the sort of the structural incompatibility between, because it's this heterogeneous merging of all these different countries that all march to different drummers. You've got the producers and savers, that's Germany, and you've got the spenders and entitlements, and that's some of the Mediterranean countries. Could you focus maybe a little bit on that, but specifically what's going on in Italy? They've got a new prime minister. Do you see anything getting less risky about the Italian financial situation than what you've pointed out in the past?
I certainly don't see things getting less risky. We'll have to see how this new government carries on. It could be. I mean, I think that I do see a political problem developing in Italy insofar as if they need help from the ECB, if they need some sort of bailout, then I think that there is going to be a conflict between the highly socialistic policies of Brussels and particularly France and Germany in terms of being the paymasters behind Brussels. And this new sort of, they call it right-wing fascist coalition in Italy. That could be a problem. But I mean, you're right to say that there are these huge differences, particularly between Germany and the southern Mediterranean states. It's always been the problem, and this has been reflected in the way Target 2 has operated. The countries which are owed money are basically, or the central banks that are owed money are the German one, the Dutch one to a lesser extent, and also Luxembourg. These effectively are savings centres, whereas the ones which are most indebted are Italy and Spain. In terms of relative to its size, you can also put Greece in that category as well. Portugal to a lesser extent. So, I mean, these are countries that really do have a huge, great problem. And one of the reasons that you've got these deficits in the Mediterranean countries is that there's a big sort of repo element in this, whereby poor collateral, which is not liked by the local regulators because they don't want to sign it off, they would rather see it shoved into the Target 2 system. So it's off their patch and they don't worry about it. And of course, when interest rates were negative, the repo rates were basically zero. So that any Italian or Spanish bank could merely get money out of the system via repos for zero. I mean, that was the source of their liquidity. And it's quite a threat, I think, potentially to the whole of the Eurozone and the Euro system. If we see rising interest rates, which we're now getting, and as the ECB has to raise its rates, this money is no longer free. It's going to come at a cost. And that, I think, is going to impact these banks very, very severely.
Do you have any further comments either on that near insolvency of the Australian central bank or the pivot that had to happen by the Bank of England and the government just in the last month here?
Yes, sure. The Australian central bank is in exactly the same position as the banks in the Euro system, in exactly the same position as the Bank of Japan and also the Fed. But less so the Bank of England. I'll come to that in a second. The problem is that whenever a central bank has indulged in QE, and the worst example of this is the Bank of Japan, which has been doing it for the last 22 years, rising interest rates undermines the value of the holdings on the balance sheet. And the result is that most of these central banks have got very, very slender capital, equity base. So technically, they've rapidly become insolvent. It's the sort of the way the Fed plays it. It says, well, most of this is we're going to hold it to maturity, which conflicts a little bit with the quantitative tightening. But anyway, we'll pass over that one. We're going to hold it to maturity, so we're not worried about market values. Well, great. I mean, you watch what happens when interest rates continue to rise, and the Fed's losing control of interest rates. Let's make no bones about it. I mean, the idea that the Fed is controlling interest rates, forget it. So the Fed is going to have a problem on this. The Bank of England does not have a problem because right when this started under Mervyn King, he very wisely said to the Treasury, well, look, if we're going to pass on the surpluses from interest payments on the gilts that we buy as our quantitative easing program, if we're going to pass that on, then we will require the Treasury to underwrite any bond losses that may or may not occur. That's what he did. And the result is, if you look at the Bank of England balance sheet, all the QE bonds are all in a special purpose vehicle, which the auditors are very happy to write, to value at unity. So they don't have any losses on their balance sheet at all. What's happened is they've moved all the losses into the UK Treasury. And of course, they will have to finance that by issuing more gilts. But that is a separate issue. I would say that the Bank of England under Lord King was very, very sensible in doing that. Other central banks, I don't think, have been nearly so sensible.
Everything we've been talking about, except for Japan, is, well, I guess maybe Japan kind of plays in the financial realm of the Western countries, but it seems to be this Western financial world, a lot of which is, you started out by talking about derivatives. It's these layers and layers of abstractions built on top of, houses of cards built on houses of cards. In contrast, you have the Eastern bloc characterized by the BRICS plus nations who are producers. They have commodities. They've been acquiring gold hand over fist for the last 5 years or more, and they've got a culture where their populace often owns gold as well. It's a completely different world. There's a question by Smart Jacks who says, how long can this charade carry on? Now we see the BRICS plus nations selling treasuries, driving down yields, yet the Fed merely buys them up. How does this eventually stop? Please explain.
What he's described, I think, is very simply the big sea change that we're seeing at the moment. We're moving away from a dollar-centric world where, because the dollar was always in demand as the reserve currency, interest rates in the dollar and also therefore in all other currencies tended to decline. A trend of financialization that has now stopped, and we're now moving away from that. And the vacuum that's likely to be filled is precisely what your viewer was saying. We're moving towards commodity-based currencies. And the thing that's fascinating is that, we look at, for example, Saudi Arabia, where the petrodollar was invented. Why is it that Saudi Arabia is now considering joining BRICS? I mean, I think I've said this on your show before, but I did, back in 2014, I interviewed a director of a Swiss refinery and gold refinery, and he said that he was taking in LBMA bars from Arab owners in the Middle East and recasting them into the Chinese 4 nines 1 kilo standard and then sending them back to the owners. They weren't being done to sell. So going back even to 2014, the geopolitics of the situation was beginning to move Saudi Arabia, and if you like, the people that really matter in Saudi Arabia, strategically towards Asia and away from the West. So that, to me, was the earliest sign that this was going on. So what we're seeing with the Saudi Arabia, with BRICS now, is a continuation of that. I think the motivation for Saudi Arabia is very, very interesting. We can understand the geopolitical play because, I mean, here in the West, we're rubbishing fossil fuels. We're giving a very strong message to the Saudis. Look, your fuel is history. We're moving away from it. By 2050, Europe's going to be completely, environmentally, we're not going to burn any fossil fuels. Oh, no. Petrol's gone, diesel's gone, whatever. So, that's hardly a friendly thing to say to the Saudis. Whereas at the same time, we know that India is very reliant on fossil fuels. China, ditto. Russia as well. I mean, they're in the same camp, as it were. So you're looking at the Asian bloc who are ignoring all this Western preoccupation with doing away with fossil fuels. So, of course, they're going to go there. But then there's another thought, and that is, could it be that the Saudis and also other nations on the edges, if you like, of this Shanghai Cooperation Organization, or the axis between Russia and China, are sort of very much on the edge of it, perhaps in Asia, are they beginning to get frightened of what they see in the West's paper currencies and would rather move away from it towards having their currencies backed more by commodities or gold? It's an interesting question. I think there may well be a growing element of that fear of a collapse of Western currencies in certain quarters. And I suspect that this is part of the Saudis' thinking.
You've just spoken about concerns from the Eastern Bloc that the West financial edifice is going to come tumbling down, starting with the currencies. What about the commodity exchanges for example, precious metals in the West? There's been a lot of criticism levied against both the COMEX and the LBMA for the past decade or more, saying that they're basically a charade. They're not there. It's the tail wagging the dog. You don't really have legitimate price discovery. They're not really being used for hedging producers as their primary function, et cetera, but for speculation, et cetera. Alan Livingston says, if the COMEX and LBMA falter, is there a potential group or individual that has the expertise to develop a new precious metals exchange where real price discovery would be the goal? And the question is that already embodied in some of the exchanges that are being created in the East?
It is being embodied it's already the case in Shanghai. The Shanghai Gold Exchange is a physical delivery exchange. You can go on their website and you'll see that they're delivering what they call withdrawals out of their vaults. And typically it's, 150 tons a month. I mean, we're talking about quite big stuff going on there. That's physical. Moscow is setting up a new exchange. We haven't heard anything new on that recently, but the problem we have in Britain, I don't know if you've got the same problem in the United States, is that our security services are blocked off the websites from Russia. So we can't really get news directly. We have to get it indirectly. But nonetheless, I think that Russia is certainly planning to replace the LBMA, as it were, not so much in the sense of dealing forward, but in the sense of having a market for its gold output, because they're now the second largest gold mining nation in the world. I mean, they really have stepped up. So those markets will be there, but they're not really all that open to you and I. And I think it's an interesting point. I think that the sort of the futures market and all the rest of it, all that's going to have to change. We'll probably end up dealing with sort of banks who actually run physical books, and I'm sure that banks will evolve in order to do that. But banks and other dealers, that will happen. But it could be that the LBMA continues, and it could be that they need to modify their contract terms in order to retain credibility. Because if the price of gold really does rocket, reflecting a collapse of paper currencies, then I have no doubt that members of the LBMA might find themselves in significant difficulties because they don't have the physical, if you like, which might be demanded of them. I mean, we're seeing this beginning when I say beginning, it's been going on for a year or so, or maybe two now, on COMEX. I mean, COMEX was never meant to be a delivery market. I mean, the only reason that there was a delivery mechanism was to just sort of tie the futures price in with the physical price on contract expiry. But nobody really expected anybody to use COMEX as a delivery mechanism. But it's routinely happening now. So, the market evolves, I think, to deal with these issues. But it does also show that I think COMEX it's got some problems. I mean, we're already seeing that there's a drain on gold and silver stocks, certainly in the registered category. And, we've also got a drain of stocks in London now. And I think quite a lot of that is central banks deciding that on the back of America's action against Russia, perhaps we ought to have control over our own reserves.
At GoldMoney, where you're the head of research, you've talked for some time about people strategically positioning themselves so that they're not entirely exposed to the vagaries of their own jurisdiction and their own currency. But there's questions about what about this strategy that people, the few, less than 0.5%, I understand, have employed of trying to position themselves into tangible assets like gold and silver, if those come under the targets of governments who don't like people having privacy and being outside of the control, under the thumb of government control. Chris Snow says, in the event that Western populations turn to metals and cryptos for their store of value and means of exchange, it may be likely that governments will outlaw their holding. How do people keep and use metals under those circumstances?
It would be absolutely crazy for governments to do that. But that's not going to stop them from doing it. That is for sure. I think silver is pretty safe. You can't really turn around and say, as a government or a central bank, we think that silver might be used as money, and therefore we're going to ban owning of silver. I mean, it's complete nonsense, because silver is, a lot of its protection is that it is actually a very much needed industrial metal. Gold is different, and I wouldn't rule out the possibility that the politicians would be stupid enough to ban gold ownership. That could well happen. The way we get round that is that the only way that ban can work with, I think, almost all jurisdictions is the possession of gold within the jurisdiction. So in other words, if American has gold stored, let's say, in an American vault or something like that, then under the Roosevelt regime, that would have to be submitted to the government. If you have gold stored outside America, but under the control of an American vaulting company, that American vaulting company could well be forced to comply with such an order, even though it is running vaults outside America. So you've got to be I think, rather cute about this. As far as storing it in vaults, let us say, in non-American companies outside, run by non-American companies outside America, I can't really see how the American authorities can stop you doing that. You should be safe, and that's one reason why at GoldMoney we've deliberately offer fully insured vaulting services in quite a number of jurisdictions, because depending where you are, you might want to store your gold in a jurisdiction within which you have no connection. So I think that is probably the only way in which you can deal with the likelihood or the possibility that the politicians would be so stupid to do that. Now, having said that, if the politicians decided to do that, I think what they would do is they would end up, they'd have two problems. Firstly, in the days of Roosevelt, I think that Americans were a lot more law-abiding than they are today. I think what you would get is a complete rebellion today against any such measure. That's the first issue I would point out. The second point I would make is that if an American administration tried to ban gold ownership in America, then I think all that would happen, nobody would submit their gold because of they're not so compliant with the law as they were back in the early 30s. What they would do, I think, is what would happen is that you would just drive the gold price up because everybody else would turn around and say, hold on a minute, we better get somewhere we can. And I think that the price of gold would rise on its own accord rather than just because the purchasing power of the dollar was going down.
Yeah, we certainly saw that phenomenon. If you want to look at the firearms history over the past 2 decades in the U.S. over the past 3 administrations, during the Obama years, there was a grave concern on many Second Amendment rights lovers' parts that this was going to come to an end, and the prices of firearms tripled. In fact, there were many cases reported where rifles were being sold for 3 times what they had just been purchased for, weeks before, that sort of thing, and ammo was extremely difficult to obtain and everything. Then Trump came in, said, got you covered, don't worry. And the industry pretty much fell flat on its face because there was called a Trump slump for the firearms industry and the ammo industry. Now it's back to people trying to grab what they can. So I think you're right that there's a huge opposite effect when people follow their gut rather than probably in reaction to trying to avoid the controls that are being imposed on them. But can we before we let this off the hook though, there used to be a saying back when we were young, people putting their money in a Swiss bank account. That meant ultimate privacy, ultimate secrecy, whatever, and then even or Bahamian or Grand Cayman, that sort of thing. And then there was this change that came back about a decade or 2 ago, where the U.S. government said, no, actually, you all are going to toe the line and play nicely with us, or else. And I don't know what the or else was, but maybe you can give us a clue of what brought a sea change to what had historically always been complete privacy in these overseas accounts, and why would that not apply to what we just said about overseas storage of metals?
Well, it could well apply. I don't think it does at the moment. It would probably require legislation of some sort or an initiative from the OECD. I mean, it was the OECD that drove the reporting side of tax haven, companies and so on and so forth, and disclosures and all the rest of it. Not everybody complies with that. When I was in Guernsey, we were forced to comply with this new, giving information, and it was particularly difficult for anyone who had American clients because the IRS were very, very fierce on the whole thing. And, you have you would just make one mistake or if you're managing assets or you are sheltering assets for an American national, even though he doesn't live in America, and you misreported or something, they just close you down. Boom. The whole thing was really draconian. So the result was that we didn't deal with any Americans. We said, sorry, no. I think that, that's, I think that could well be extended to vaults. But what I would say is that all you can do as a very last resort is just make it difficult for your government to, steal your property from you. That's all you can do. It's all you really can do. But again, I'd like to make the point that it would be the most stupid thing for any government to do, because what they would do is they'd be telling the market, look, we've got a rubbish currency and we're trying to protect our rubbish currency. What? Where does this put, China would then turn around and say, okay, we got 30,000 tons. What? Russia, we already know, has got 12,000 tons, and I understand that they've passed legislation so that they can add gold from other state accounts into the Reserve Bank of Russia's reserves. So, already I think this, the bird has flown on this story, which would make any move by the politicians, really ridiculous. And the other thing that they would be doing is they would be cutting off, and I know they won't be thinking about this probably until too late, but they would be cutting off the route of securing stability in their own currencies. I mean, the whole point about a collapsed currency is that it has then only one use, and that is as a means of distributing a new currency on a sound basis. And the only way you do that when you've lost all credibility, like you're rather like Venezuela at this stage, or the Venezuelan government. The only way you can do that is to say, right, okay, we'll take, say, every $100,000 or whatever the figure is, and we will fix that to 1 ounce of gold. And if you turn up with $100,000 and you want to swap it for 1 ounce of gold, we will give you a gold eagle. I don't know if that weighs it at 1 ounce, but do you see what I mean? I mean, that is what Britain did with the gold coin standard under the sovereign, which was introduced in 1817, and secured the wealth of this country until the First World War. I mean, we became the most powerful nation on earth under a gold standard. What it did was it removed the temptation from government to finance anything by printing money. I'm not saying that it was an absolutely smooth course of events. I mean, we had banking crises and all the rest of it. I mean, you don't stop that. But the one thing you do is you ensure that credit in the market, which is either in the form of banknotes or alternatively in the form of bank deposits, will always be exchangeable for gold, and therefore the value is pegged. You need to retain that credibility. That's the only way to do it. I mean, we went on to a bullion standard in 1925, trying to get back onto a gold standard. But the problem there was that you were cutting out the ordinary person, because a bullion standard, basically, if you had a 12.5 kilo bar or a 400 ounce LBMA, what became the LBMA standard bar, then you could exchange that for sterling. But who has enough gold to have a 400 ounce bar? I mean, very, very few people. So, this was not a gold standard that worked for the people. It just worked for the mega rich and for, bankers, if you like. So, it's quite clear that any such action by governments would actually cut them off from recovering the currency situation, which they have created in the first place.
Well, there's two things about what you had just said that didn't make me feel a lot better. One was that this would be unlikely because it would be so very stupid on the part of governments, and because it would be so destructive on their own countries, the well-being and everything. But if you look over the last 2.5 years, we've seen such a litany of actions which were so destructive on countries and their well-being and their economies and their businesses and their people and everything, that it almost is chilling to think, well, either they're unbelievably stupid or they're solving for a completely different function than the well-being of their people. That's what I think a lot of people are really concerned about. The second was that it would be that the only way to reestablish control is through confidence by the people in a sound money or sound currency based on precious metals. We've seen throughout history, and certainly more recently here, that draconian use of force. The threat of force, as you mentioned, the IRS just shutting companies down if they towed one toe off the line, even if they were foreign countries, that sort of companies. So anyway, that's another concern that people have, is that force will replace confidence going forward. If you're not going to be confident, okay, then we're going to use force to make sure you're compliant. So it doesn't always make people feel better. Back to the very beginning, just to wrap up kind of where we started with your upcoming article on the derivatives Unwind 2.0. We have a question from Billy Goat who says, Alasdair, could you please explain what the process of, quote, reducing or winding down a bank's balance sheet means? What elements of the balance sheet are affected? What conditions lead to it as being a desirable thing to do? How it affects banking and stockholder equity? Who's harmed by the process? And how it affects depositors and borrowers? Perhaps an example of all this would be helpful to our understanding.
Yeah, it's really... the way to explain it is it's all part of the bank credit cycle. And what do I mean by the bank credit cycle? Well, bankers are human, and they will be reluctant to lend in economic conditions which they feel uncomfortable with. But inevitably, what happens after you've had let's say, a downturn in the cycle, and which is a recession, if you like, or a slump, what happens is that you find that people start trying to find value in things. You find that known to the banks, that is, company doctors or corporate rescue specialists and all the rest of it, start putting together deals. And because they've got a good relationship with the banks, they get the financing for it. Or alternatively, the bank will see, let us say, it's got a troubled customer, an old legacy business, which is falling on hard times. It needs new management and all the rest of it. So, someone comes along and says, I want to do a reverse takeover into that company and take it out, but I'm going to need financing. And the bank will underwrite it and so on. And gradually what happens is that as this credit starts expanding, you find that economic confidence begins to grow. And it's actually growing on the back of credit, which is being created by the banks. The banks don't necessarily realize this. But what they see is improving conditions. And gradually, into those improving conditions, they start lending or start making credit available to more and more businesses, cautiously at first. But then it gets to a point where all the banks start doing it, and they start competing with each other to do it. So while you've got this expansion of credit going into the economy, you find that interest rates actually fall again. I mean, they fall not because there's no demand. They fall because the banks are competing to lend. And what they're doing, as far as their own balance sheets are concerned, is they're increasing the ratio of total assets to the underlying equity on the liability side of their balance sheet. And typically, they will go from something like, say, a multiple of 6 or 7 times equity to perhaps 8, 9, 10 times equity. And when you get up to sort of 10, and maybe some of them are going on to sort of 12 times equity, at that stage, the earlier business plans which were put forward to the banks start going awry. Why? Because all this extra credit has had the effect of pushing up prices. And the recovery in the economy means that there are shortages of things, like there are shortages of skilled labor, there are shortages of semi-manufactured products. You get these shortages developing and bottlenecks, which start driving up prices even more. So what do the bankers do at that stage? Well, they begin to get cautious. And so instead of just more or less automatically trying to expand their balance sheets, they sort of think, well, hold on a minute. These sort of business plans amongst our customers seem to be going wrong. This means that if we're not very careful, we're going to end up with a lot of non-performing loans. So, we better slow down. But the problem is that it isn't just one banker thinking this. They all think in exactly the same way. They're like a bunch of investors going for tech stock. They're all bullish or they're all bearish. And so, it's a very volatile situation. I mean, so what you get is you then get banks withdrawing credit availability. And if you look at the stats which are available on Fred, the St. Louis Fred, you can see that loan officer surveys, they're all saying, well, we're getting cautious and we're not lending anymore to large, medium and small sized businesses. So, that is what we're beginning to see. They're trying to contract their balance sheets. Now, initially, what they're doing in this current environment is they're doing this in the financial sector. They see rising interest rates, which undermines bond yields, which undermines equities. Now, they don't necessarily have much in the way of equities on their balance sheet. They will probably have some bonds, but they probably don't have bonds with a maturity of more than a couple of years. But where they do have exposure was collateral. The collateral which is held against their customer loans is more financial in character than it has ever been in the past. And they're looking at the value of this collateral, and it is scaring them badly. It really is. So what they're trying to do is they're trying to just pull out of everything they possibly can. And we have seen, for example, the loans margin credit on Nasdaq that has started contracting very, very sharply. There are other signs of this going on if you look for it. They're not so much withdrawing credit from consumers, but they are withdrawing it from businesses. And it's really, at the moment, you really see this in the financial sector, and that is beginning to go into the underlying economy. So to answer the question, we will see a contraction of loans generally. You'll find that businesses with existing overdraft facilities are told by their bankers, we're not going to renew these facilities, so they will run off in that way as well. And the other side of the balance sheet, so of course deposits. Now the deposits are created by the loans. So as you reduce your loans, then deposits are going to start reducing. So what you will see is broad money contracting. Now, we're already seeing signs that this is now happening. And as broad money contracts, then guess what? GDP, all the transactions pretty much in GDP are settled in bank credit. So, I mean, there may be some cash transactions, but, at the retail front, as it were, but, that's pretty minor now. So if you get contracting bank credit, you've got less bank credit to settle transactions. And so that's going to be reflected in a fall in GDP. So, then you've got a situation where the bankers can see that the economy is definitely turning down. They don't necessarily understand what I've just said because their economic advisors don't understand money, paradoxically. So they then think, my God, this economy is really going down. So they get more aggressive in trying to get rid of the leverage on their balance sheets. And the amazing thing is that with all the regulation that we have, Basel's 1, 2, and 3, and all being put into legislation and regulations, in America, Europe, wherever. The one thing that they don't actually care too much about, these regulators, is the amount of leverage between the total assets on the balance sheet and the equity base. What they say is that the maximum leverage between what they call Tier 1 capital and the balance sheet's total assets is 33 times. 33 times. I mean, that's absolutely ridiculous. Now, there are sort of, it's not a straightforward calculation, but, you get the idea that the regulators couldn't give a stuff about the shareholders and that relationship. But that is the primary responsibility of a board of directors, to get returns for the shareholders and to protect the shareholders from losses. Are they doing it? Some of them are. You may recall that Jamie Dimon stood up, I think it was in April this year, at a banking conference in New York, and said 2 weeks ago, I said that the US economy was facing a storm. I've upgraded that to a hurricane. And we at JPM will take action to protect our shareholders from this hurricane. Oh, he was told by the Fed, whoa. And what you then had was the chief economist at JPMorgan was sort of had to row back on those comments. But you could see even then which way this was going. It was the end of the expansionary cycle. Bankers were getting really worried. And if Jamie Dimon says something, he is the most powerful banker, commercial banker in the world. Everybody listens to him in the banking community. That, I think, really did mark the top, if you like, of bank credit expansion. And any banker who's ignored that warning from Jamie Dimon really should be sacked. And that's where we are now.
Well, it's certainly getting to be a time of heightened concern. You've been warning us for some time now, a couple of years, and especially in the last few quarters, about the growing crisis in the banking system, somewhat focused on the Eurozone. And we're watching that with you, with concern, and we rely on your insights there to help us stay aware so we can be better prepared. If people want to follow your work, how should they do that?
Well, the answer is to log in to goldmoney.com and hit the research tab, and you'll find all my writings there. I do an article on Thursday, which is tomorrow, given we're recording this on Wednesday, and I do a market report on the Friday, which is basically the background, if you like, to gold and silver.
And folks, if you don't want to miss a single episode with Alasdair or any of our guests here on Liberty and Finance, make sure that you go to libertyandfinance.com, libertyandfinance.com, put your name, email address, click submit. You'll get a confirming email once you respond to that. You're in our mailing list. It's completely free. 1 email per day in your inbox with our latest interviews and any specials so that you can stay up to date. Alasdair, as always, on behalf of all of our viewers, just thank you for joining us and giving us this monthly education lesson here on Liberty and Finance.
It's my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.